Hey everybody, Ben Hart here. It is Thursday, August 20th, around 1:30. I'm just going to give an update, just me today. So I'll give you an update on what's going on in the world. Lots changes, obviously, lots going on in interest rates and the Middle East and so many other things. So let's start off with what's most recent. As of yesterday, we had Treasury Secretary Scott Bessent come in and had the first intervention in the bond market that we've seen in some time. I've been writing about and talking about what's going on in the long end of interest rates in the US for quite some time. As I mentioned, as we got through 5% on the 30 year, I said we'd start to see some pressure potentially on the consumer, on housing, on so many things that go into the current economic conditions that we have in Canada, the US, and most of the world. So we need growth to grow, and higher interest rates puts pressure on growth. And so what we saw was Scott Bessent come out and say that they were going to put a certain amount of money towards the long end of bonds. So effectively right now they've been selling short ends and buying long end. So much news buzz on the financial media around what this means. Is this QE? Is this not QE? Is this yield curve control? So one of the things that Japan did when they got into difficulty in their debt levels and such, they did what's called yield curve control, which is they set a cap on how high yields can go. And they did it with a verbal cap where we said rates are at this level, above this level, we're buying it all day. Well, yesterday's Treasury Secretary didn't say that explicitly, but we saw it with the market levels. So when that 30 year in the US went above 525, effectively that's where he started to intervene in the markets. And so this is different from the Fed intervention. This is the Treasury Secretary intervention where they're buying that end. Now, what's going to happen from here and into the future, I guess we'll see. And from the looks of things, it is not QE yet, but likely in the early days of something that looks like QE, which is quantitative easing, which is easier financial conditions, which pulls rates down, either with a Fed put or a Treasury Secretary put, which is what we're seeing right now. So yesterday we had knee-jerk reaction from government bonds around the world where everything went down. So prices went up and yields went down on the back of this. First central bank to really intervene materially, and the US, which is the world reserve currency, is the biggest as such. So this will be a key important theme to watch over the next weeks, months, years as he continues to intervene in the rates market. So this is a key piece where you could make money in bonds if this happens, where there's massive intervention. They want to push down yields to better levels, which will stimulate spending and support the consumer. So important key piece to watch. Also, it has an impact and knock and trickle down effect to the growth companies. Obviously, lower rates helps these growth businesses, the AIs, the techs. So maybe it prolongs the current environment that we're in, which is lower rates results in more spending and capex and so on and so forth. So that'll be another key knock-on piece to watch. So I'm going to jump into the slides. We'll go through that. I'll give a few more comments around what I see happening in corporate news as well. But let's jump into the slides right now. All right, as I said, this is August 20th, and we're going to jump in. So anything that happens between now and next Thursday, we'll give an update on then, but that's where we'll start with today. So what I wanted to look at is there was a Bloomberg piece that came out about a week and a half, 2 weeks ago, I think early August, which talked about there's a lot of money flowing into the Canadian bond market and almost a thinking around how Canada's positioned themselves from here going forward. And so this is a great chart from our economics team. It's called Non-Residents Are Binging on Canadian Bonds. And so if we look at this layout, you can see that January, February, until we are today, this is the prior number. So if we look at here, the prior 10-year average from 2016, 2025, what the buyers look like. Something in the neighborhood of 10 to $12 billion in January, became 52 February, just around 10, 22, and then April, incredible. In June, we've seen a massive buying spree happening from international buyers. So this is ex-Canadians have been buying bonds. So it does make a bit more sense as to why and how the Canadian dollar has stayed where it is, given the other things happening in the world. But the Canadian dollar has been relatively strong. Reason being is foreign investors are buying Canadian bonds. This is a pro and a con. You can look at it from the perspective that this is a positive. People feel comfortable and safe with Canadian bonds. They understand who the government is, what the expected potential taxes or non-taxes, and they have some comfort in knowing what that's going to mean. So big buyers in the Canadian bond market. So what does this mean? So foreign investors now hold $2.5 trillion in Canadian bonds. So there's this, I think there, as I've learned and grown over the years, people have felt that, Canadian bond market is relatively small. But if you look at this now, you can see 2.5 trillion is owned by foreigners. And so why this is relevant and important is because those institutions, governments, people that own these foreign bonds actually have some leverage over us and how things go. And so one of the key pieces I think is interesting to think about is this is what the breakdown is. So this is the UK, other EU, Japan, other OECD, and all others. But if we look at who have been the biggest buyers, and by far it's been the US, 43% of these buyers have been US denominated. So individuals, corporations have been supporting the Canadian bond market and in turn supporting the Canadian economy, which is a bit ironic given where we are today and all the pressure that the US government is putting on Canada. Biggest buyers have been US denominated individuals. And so great look as well here is what chart for us is what bonds are being bought and from where. So net foreign purchases of Canadian bonds by sector, currency, and geography. So I think this is a great look. So by sector, this is historical, as you know, 2020. This one says 2025, so this is last year versus this year. So $80 billion of the issuance has come from the government of Canada. So this is interesting. If you look at where money's flowing, and the big buyers have been buying government debt. So that's probably part and parcel to Carney and what he's been doing to give us exposure to what's going on in the world, saying, we work together, support each other, giving some confidence in what Canada can do. So a lot of that money is flowed to government bonds, which I think is interesting, certainly from a perspective of what that means to asset allocation within portfolios. Other governments similar, and then corporations. So corps have only been 60 billion, where it's interesting to see what that looks like. The other piece, I guess, to look at here would be the currency. So CAD, USD, and then others, again, primarily denominated in Canadian dollars, which is supported the Canadian dollar. And so that is an interesting piece. Some in US dollars. So I have heard that some corporations and institutions have been wanting to buy Canadian government denominated US dollars, gives them a bit of exposure to the US dollar, but some comfort in some of the other risks that the US is going through. And then the buyer by geography. I mean, we saw that previous slide, but what you can see here is, again, primarily denominated by US, a little bit UK, Europe, and others. Others are actually sellers last year, but this year we've been in a slightly higher case. Last chart, which I also think is very important, very similar. Thought it'd be interesting to highlight how the purchases have been coming into the Canadian market with a focus here. So if you look at this chart, the largest share of Government of Canada market. And so for the first time, what we're seeing here is foreign investors hold a bigger share of the Government of Canada domestic bond market than Canadians do. That's an interesting number, and I think it's worth thinking about. For me, I think what's more important if we do see a slowdown is this is the Bank of Canada. And so the Bank of Canada has been ever so slowly over the past many years has been not renewing. They've been rolling off their bonds that they have on their balance sheets. And so now the Bank of Canada is a small shareholder. And so I think this is extremely important just when we think about what could potentially happen. If we do see an economic slowdown, where we saw Bissent yesterday talk about intervening and trying to keep rates down, since the Bank of Canada, which was the buyer of last resort from the COVID crisis, they had to intervene, they had to buy, keep yields down, so on and so forth, now have quite a bit more ability and leverage to be able to intervene. And if they get in a position where they want to push rates down or flatten the curve to some extent, they now are in a position to do so because they don't have as much of the bonds on their balance sheet. So great chart, interesting to think about into regards to where the buyers have been coming into Canadian bond market. So there's two ways to think about this. One is if this continues, if we continue to see positive momentum, foreign investors like the Canadian market, like what Carney's doing, then we have some stability upside, yields stay relatively muted, some positive flows continue to come in Canada. There's some school of thought and thinking that maybe this flows over into Canadian equities as well. So I think that's something to think about. And me, as always, I look at it from both perspectives, and the other one is the risk side of this equation. And the risk side of this equation says if the foreign investors start to look the other way, one, stop buying, that's negative, and start selling, that's a big negative. So this is a risk to Canada and the Canadian dollar that I think we need to be watchful and thoughtful on. And so this is how I would think about why this is such an important piece today in the Canadian investment landscape. So as always, the opinions expressed do not necessarily reflect those in National Bank Financial. I prepared this with the best of my judgment. Everyone has their own unique risk tolerance. If there's anything that you'd ever want to discuss that we talk about, please feel free to reach out, either book a meeting with me or reach out to Eva and book one as well. We're happy to discuss and address anything that you think is relevant for you or your portfolio, or for individuals that aren't clients as well. Happy to have a discussion on where and how this could affect your portfolio that you're currently managing. That's it for the charts today, and we'll wrap up. So thanks so much for joining me today. I think there's so many things going on. I think one of the key pieces is government intervention now that we're starting to see. We saw the US government intervene in the Japanese yen market, trying to support yen and doing some financial maneuvering then. Now we've seen them intervene into the US Treasury market. So I think this is going to be a key theme over the next 6 to 18 months that we're going to need to watch. As debt levels start to rise, that fear continues to come. We saw gold, silver rally off this news yesterday. We've seen crypto rally with follow through in crypto today. So I think there's lots of moving parts. AI is going extremely quickly. Anthropic released their earnings earlier this week. Incredible earnings growth right now. So lots to pay attention to, lots of moving parts, but I think rates is going to be a big key piece to see how this plays out over the next 6 to 18 months. So thanks so much for joining me. Always appreciate you listening, watching. Please share with your friends. If there's any questions that you have at any time, please reach out to us as well. So have a great weekend. Have a great rest of the week, and we'll see you back next week.